Welcome to The Deep Dive, the show where we cut through the noise and get right to the most important nuggets of knowledge. Today, we're diving deep into the second quarter 2025 earnings call for Northrop Grumman, a real titan in the aerospace and defense sector. Our mission for this deep dive is simple: unpack their key financial performance, dig into what management's thinking about their big programs and strategy, and, figure out what it all means for you in the broader investment landscape. Okay, let's kick off with the headline numbers. Northrop Grumman, well, they delivered a pretty robust second quarter. We're talking sales of $10.4 billion. Now, that's only a 1% increase year over year. But what really jumped out, I think, was the strong 9% sequential jump from Q1. And every single segment contributed to that growth. And if you look at organic sales, stripping out M&A, they were still up a solid 2% year over year.
Yeah, and operationally, that strength wasn't just, top line. Segment operating margin expanded by a full 100 basis points year over year, got up to 11.8%. And that directly drove an 11% increase in segment operating income. That's a pretty strong sign of underlying efficiency improving.
Right, and that translates directly to the bottom line, doesn't it? Diluted earnings per share soared to $8.15. That's an impressive 28% increase compared to Q2 last year.
Wow.
Now, okay, a part of that was boosted by selling off their training services business, sure, but the main driver was really that strong operational performance we were just talking about.
Absolutely. And for anyone watching cash flow, this quarter showed significant improvement. They generated, $637 million in free cash flow?
Yeah.
That sets a really strong pace for the rest of the year. Shows they can convert those earnings into actual cash.
Okay, so those are some pretty impressive top-line figures. Let's peel back the layers a bit and really understand what programs and, strategic moves are fueling this. What were the standout stories operationally in each segment this quarter, beyond just the raw numbers?
Right. Okay, kicking it off with defense systems. They had a truly standout quarter, 12.7% margin rate.
Wow.
Yeah, and what's fascinating here is that this was largely driven by a pretty significant favorable earnings adjustment on the Sentinel program. And this isn't just, some accounting thing. It signals management's really got increased confidence that they finally untangled some of the knots on this critical ICBM program. It's based on expectations for hitting certain contract incentives.
Okay.
Sales for DS grew 7% on a GAAP basis, and even more impressively, 9% organically. Sentinel and higher ammunition sales were the big drivers there.
That's a big vote of confidence for Sentinel, then. That program's certainly seen its share of headlines. And then you mentioned mission systems was their fastest growing segment, up 14% year over year. What was behind that surge?
Yeah, mission systems, that growth was mostly due to some inventory liquidation on a restricted award. They actually thought that might hit in Q1, but it landed here. And also just strong growth in their marine programs.
Okay.
Margins there expanded to 14%, mostly due to better production efficiencies. I think airborne radar program's doing better.
Right. Disciplined execution paying off.
Exactly.
Meanwhile, Aeronautics Systems, sales up 2% year over year.
I imagine the B-21 bomber played a pretty big role there.
It certainly did, yeah. Higher volume on the B-21 Raider, the next-gen stealth bomber. And also the less talked about but still vital Takamo program.
Ah, yes.
That's take charge and move out, basically an airborne command post making sure comms work in a crisis. Those are the main drivers for aeronautics.
Right, shows the diversity beyond just the flagship programs. And finally, space systems. What was the story there? It looked a bit lower.
Yeah, space system sales were lower. That was expected, though. It's primarily due to the planned wind down of two specific programs, created about $283 million in year-over-year headwinds.
Okay.
But interestingly, despite that lower volume, their operating margin actually improved by 50 basis points from last year's Q2, mostly driven by higher net EAC adjustments.
Estimated completion adjustments.
Right, exactly. Means they're getting better at projecting and managing costs on those long-term contracts. Okay, that strong performance really sets the stage for what's coming next. What does management's updated full-year guidance tell us about the momentum they're expecting, especially, in the second half?
Well, management's keeping their top-line outlook steady for aeronautics and defense systems. Yeah. Consistent there. But they are increasing sales expectations for mission systems, given that strong performance we just discussed.
I think so.
And for space, they're now projecting sales in the mid to high $10 billion range. That's largely because of a key award decision on the ESS program.
The environmental sensing satellite.
That's the one. Critical next-gen weather and climate monitoring. That's a big win for them.
Okay. So when you roll all that up to the company level, they're narrowing their overall organic sales growth outlook to, what, approximately 3% for the year?
Yeah, around 3%.
Which, I mean, that implies a pretty significant acceleration in the second half, right? Sales expected to be higher than the first half by about $2.5 billion.
That's the number. Yeah, $2.5 billion higher. And they broke down how they get there. Three main things driving that second half ramp.
Okay.
First, they expect about $750 million in higher sales just from key programs ramping up. Think B-21, Sentinel, and Columbia, the submarine program. They're specifically looking for B-21 LRIP, low-rate initial production, Lot 3 and Lot 5 awards in Q4. That'll bring significant revenue from inventory liquidations.
Got it. And the second factor?
Nearly $700 million coming from the ramp-up of recently awarded new programs. So that TACO program, IBCS, the Integrated Battle Command System, some international ground-based radars, and multiple ammunition programs, just shows new contracts starting to hit the books.
Okay, breadth of wins kicking in. And the final piece?
Around $1 billion, they figure, just from normal seasonality. Q4 is historically their strongest quarter for revenue, government contracting cycles, year-end funding, that sort of thing.
Makes sense.
So yeah, it's a mix. Specific program acceleration, new awards kicking in, and just the usual business rhythm.
And on the earnings side, they bumped guidance there, too.
They did. Increased the guidance range for segment operating income by $50 million at the midpoint, primarily driven by those strong defense systems margins we saw.
Okay.
And earnings per share guidance was raised by $0.05, 0.05 cents, to a new range of $25 to $25 to 40 cents. Though that was partially offset by some non-operational stuff, like changes to R&D tax credits, which actually ticked up their estimated tax rate a little bit.
Right, always moving pieces there.
Always. And critically for cash flow, they've increased their 2025 free cash flow guidance pretty significantly, now between $3.05 billion and $3.35 billion.
And that's mostly tax-related.
Largely, yeah. Favorable revision to Section 174 in the tax code related to R&D expenses basically lets them deduct more research costs faster, boosting cash. They also expect Q4 to be the biggest quarter for cash gen, driven by lower cash tax payments than higher milestone payments coming in and those inventory liquidations we mentioned.
All right, so with those internal numbers kind of setting the stage, my mind immediately jumps to the bigger picture. What are the broader market dynamics, the geopolitical stuff that Northrop Grumman's highlighting, and how are they responding strategically?
Well, the international market strength is just undeniable.
Yeah.
International sales grew an impressive 18% year over year in Q2.
18%.
Yeah, and they're up 14% year to date. That reflects a really strong international book-to-bill of 1.4.
Good sign for future revenue.
Absolutely. New orders across aircraft, weapons, missile defense, airborne systems. It's broad based.
And this demand is truly global, right? Driven by defense investments from the U.S. and allies. Management made a point of highlighting the recent reconciliation bill and the FY26 budget request. Together, that's like a 22% jump in procurement and RDT&E over FY22 levels.
Right.
They seem to see that as a clear sign the government's serious about cutting red tape and accelerating these critical programs.
Yeah, they definitely framed it that way. And in Europe specifically, they're seeing big opportunities for their IBCS system and various weapons. In the Middle East, several multi-billion-dollar opportunities are on the table. Integrated air and missile defense, munitions, ground-based radars.
And their strategy there involves partnerships.
Extensive partnerships, yeah. Supporting local industry growth. They mentioned a co-production agreement with a Lithuanian provider for munitions as an example. It really reflects this sort of generational shift in defense spending happening in Europe, plus ongoing NATO commitments.
Okay, let's zoom in on those key programs and growth initiatives that are really driving the future opportunities. The B-21 program, it just seems consistently well supported by DoD and Congress. What's the latest there?
Yeah, B-21 got an additional $4.5 billion through that reconciliation bill, specifically earmarked to increase production capacity.
Wow.
And they're in ongoing talks with the Air Force about accelerating the production ramp. Now, that would mean more investment from Northrop Grumman, but it also opens the door for potentially improved returns on current and future production lots. Management even suggested B-21 could potentially exceed 10% of total company revenue down the line. Depends on that final agreement on the ramp rate, but still.
Clearly a massive long-term growth engine.
No doubt.
And on the Sentinel program, that's had its challenges. What's the progress on the restructuring side?
Significant progress is the word from them. The work suspension on the command and launch part, that's been lifted. Major positive step.
Okay.
And that progress, plus the open talks with the Air Force about accelerating things, that's what led to that positive earnings adjustment this quarter. It reflects, much higher confidence in hitting performance incentives. They really view it as a fundamental shift in how the program's running now, moving past those earlier hurdles.
Good to hear. Northrop Grumman also sees itself playing a big role in this Golden Dome for America Homeland Defense initiative. Aims for initial capability pretty soon, right? What does that involve for them?
Yeah, Golden Dome. It includes leveraging their current stuff like IBCS, Gator, Triton, but also developing new innovations like space-based interceptors. They mentioned those are currently undergoing ground-based testing.
Interesting.
This whole initiative is expected to be a pretty big driver for increased budgets in their space systems sector. They project space will start growing again into 2026 after a couple of sort of flat years. It's all about layered defense.
Right. And beyond specific programs, they're making some big strategic investments in just, capacity and innovation overall. What's standing out there?
Well, their investment in solid rocket motors is a huge one. They've poured $1 billion over the last 6 years into boosting capacity across multiple sites.
$1 billion.
Yeah, and they just got picked by the Navy to provide a 21-inch second-stage solid rocket motor. Get this. They developed and demoed it in less than a year.
Wow, that's fast.
Super fast.
Yeah.
Shows rapid innovation capability. They expect to nearly double their total annual SRM production from 13,000 units today up to 25,000 by 2029. Small, medium, large motors, whole range.
And that feeds into
Critical opportunities, tactical weapons, second sourcing missiles, hypersonics, especially for their defense systems business. It's like a foundational capability they're building out.
Okay. And what about this beacon thing? That sounded pretty intriguing on the call.
Beacon. Yeah, they revealed that in Q2. It's basically a flying mission test bed. Leverages decades of their experience and autonomy, over 500,000 autonomous flight hours logged.
So what does it do?
It lets other industry partners plug in and test their software and hardware in a real-world flying environment. The idea is to accelerate autonomous mission capabilities, supporting the administration's push for next-gen autonomous systems.
So it's collaborative.
Very much so. Not just selling hardware or software, but partnering to create integrated, cutting-edge solutions faster.
Okay. Now, despite all these significant investments back into the business, R&D capacity, they seem really committed to returning capital to shareholders.
Oh, absolutely. That's a clear priority.
Yeah.
They aim to return roughly 100% of their free cash flow through dividends and share buybacks.
And they're walking the talk, it seems. They bought back nearly $900 million in stock just in the first half, and they just announced a 12% hike in their quarterly dividend. That's 22 years in a row of increased?
22nd consecutive annual increase, yeah. Pretty strong track record.
It's impressive consistency.
Definitely. And over the past decade, they've increased that dividend at about an 11% compounded annual growth rate. It really signals a company that throws off cash consistently and is dedicated to getting it back to shareholders. So this brings us to the important question, right? For you, the listener, the investor, looking at the defense sector, what does all this really mean?
Well, we're definitely seeing clear tailwinds here. Robust global demand, a favorable funding environment. The U.S. government's focus, that renewed focus on accelerating capabilities, cutting red tape, like management said, that seems to be directly translating into better program execution and a more positive outlook for guys like Northrop Grumman. It really does feel like maybe a new era of defense spending.
I think so. And the sheer amount of funding flowing into critical programs like B-21 and Sentinel, combine that with the sort of generational shift in defense spending in Europe and the Middle East, it provides a really strong multi-year growth runway. Northrop Grumman's strategic bets in areas like solid rocket motors and autonomy, plus their established portfolio of those, exquisite systems.
It's like the high-end stuff.
Yeah, the really specialized high-performance systems. It positions them exceptionally well to capitalize on what defense departments need next. That includes the big shift towards more integrated, more distributed capabilities.
And for investors, I think the key takeaway is the company's ability to consistently generate strong free cash flow, even while making these big investments. That, plus their unwavering commitment to shareholder returns, it really provides a compelling story for long-term value creation.
Okay, standard disclaimer time. This is absolutely not financial advice, and you should always do your own due diligence, your own homework. But for those of you looking at potentially actionable ideas coming out of this deep dive, thinking about that. Given the really significant extra funding for B-21, that $4.5 billion just for production capacity from the reconciliation bill, and management explicitly talking about an accelerated ramp possibly leading to better returns even on those early LRIP lots.
Mm-hmm.
A bold, maybe, but plausible idea could be to consider how the market might eventually re-rate Northrop Grumman stock based on this.
Meaning
The specific details of that accelerated production deal with the Air Force, which they expect in the coming months, that could be a powerful catalyst. This isn't just about more revenue down the line. It's about potentially much better profit margins on a program that's going to define their business for decades.
Right.
So investors might anticipate this by, say, looking at longer-term positions, perhaps using options, betting on the market fully digesting this really significant positive shift in a critical long-duration program once that deal is formalized. Just a thought.
Okay, an aggressive but plausible angle grounded in the call's details. So to quickly recap this deep dive, Northrop Grumman delivered, frankly, an outstanding quarter. Strong sales, expanding margins, much better cash flow, all leading to increased full-year guidance pretty much across the board.
Yeah, the performance really underscores the value of having that diversified portfolio, their disciplined execution on programs, especially turning Sentinel around, and those forward-looking strategic investments in things like SRMs and autonomy. And it's all happening against a backdrop of really strong global demand.
So as we wrap up this deep dive, here's maybe a final thought to leave you with. In a world that seems to be grappling with more geopolitical tension, this renewed global focus on defense, companies like Northrop Grumman, they aren't just responding to market demand anymore. In many ways, they're actively shaping the future of global security itself. What does that really mean for how we as a society view the defense industry going forward? Something to think about.
And just one last time, remember, everything we discussed here is for informational purposes only. It is definitely not financial advice.
Thank you for joining us on this deep dive. We really appreciate your continued interest and insights.